Good evening, everyone. Am I audible now? Okay, fine. So I hope all of you went to the CanSlim webinar which we had on Friday, and I think the voice is audible now. If you're not able to hear me, kindly check your mic. Okay, again, before I proceed further, I request all of you to kindly be on mute mode and just turn off your webcam. Okay, so any queries from the last webinar we had? You got good 2 days, even we provided the recordings of the webinar. So any question on canceling? So today basically I'll be discussing on the buy and sell strategies and what are the buy and sell rules. I will talk about the base patterns, and after that how do you do the technical analysis after the fundamental, after you're done with the fundamentals. So in the last webinar on canceling, we spoke about we expanded all the acronym of canceling. So where C stands for current earnings, A stands for annual earnings, N stands for anything new about the company, S stands for the supply and demand, I stands for the institutional sponsorship, L stands for leaders. So the stocks which we select should be the market leader in the specific sectors and should not be a laggard. So, and M stands for the market direction. So I discussed in details how we segregate the market direction, and that is the major strength about O'Neill's methodology, that we are good in timing the market. And as I told you guys that it's important, uh, like I gave an example of Infosys, I gave an example of ITC, gave an example of Bajaj Finance. So where even if you know that the stock is particularly good, but then if you are not good in timing your buying and selling point, you might just make, say, even negative returns from a good quality stock. So timing is very important, and timing is based on your charts. Am I audible now? Yeah, again, I'm seeing a few people pinging that they're not able to hear. Okay, cool. So any question from the last webinar we did? I think by now you guys have been assigned the mentors. You have the email ID of your mentors, and so for any further clarifications post this webinar, or for any thing strategies, if you want to know anything about the canceling, you can mail it to them. But for any generic questions, kindly contact SRCC and not to us, because we may not be able to answer those questions. We are not the perfect guys to answer that. Okay. So today I'll take you through the different base patterns which we have in canceling. Not all, the three most common. In canceling has 6 to 8 base patterns. We'll not talk about the bottom five. We'll just talk about the top three, because those are pretty much common. And now I would like to tell you about the fundamentals and technicals. What all are important enough when you see the fundamentals of a company, and how canceling is segregated between fundamentals and technicals. It's 80% fundamentals and 20% technicals. Or if I can put it in another way, we do all the fundamental analysis with which any uh, which any strategy would do. So it's like 100% fundamentals, but that extra 20% of the technicals we do focus on. So in fundamentals includes the earnings of a company, sales, new products or service. So C, A, N, and L is the fundamental criteria of canceling, and SLIM is your technical parameter of the canceling strategy. So technicals are specific to the stocks, it's stock price, trading volume, institutional sponsorship. I explained you guys in the last webinar why fund holding is very important for the stock which you are picking up. So uh, funds tend to give support at key levels. That's your 50-day moving average or sometimes 200-day moving average. So during that time, if funds are already holding the stock, they will tend to give the support. So this is a basic chart, and it might be new to a lot of you because technical analysis is a bit complicated compared to fundamentals. So normally, yeah. So this particular candle is your daily chart on a daily, or this is basically a daily chart, and you will see this blue mark, this kind of a stick, which is your daily price movement. Or a, this entire vertical and horizontal thing which you are saying is your daily price movement. This in particular will tell you the current part. If you see the intraday price, this particular movement will tell you what's the current stock price, and on a closing basis, this if this candle, if you see this particular candle, so this vertical thing will tell you the entire range, entire day's trading range. So stock traded in between this range. This was the high, this was the low, and where it closed, it will be marked by this. So this is how you should see. You should be seeing the daily candles, and now coming to the chart, these are the volumes and these are the price. So price and volume action is what we need to see. After that, this red line is the 50-day moving average, and this blue line, though you can change it. Normally, red is 50 DMA, and in MarketSmith India app, you will get black, which is your 200-day moving average. You can change it to green. So in this particular chart, it has been changed to green. This blue line, this one which you are seeing is your price strength line, which I told you that it's something which is kind of similar to relative strength in the technical analysis. However, this in our case, price strength is our proprietary rating, so we don't disclose the calculations here. However, just for your understanding, price strength above 80 is very good. This means that how this particular stock is trading in compared to the general market. So if a stock has a price strength rating of say 85 90, that means it's trading pretty well in compared to the Nifty or Sensex index as a whole. So red candles is when the stock is falling down. Correspondingly, you will have a red volume candle. Blue is when a stock is going up, and again this volumes will be blue in the will be of a blue color during that particular point of time. Uh, After that, mostly, yeah. So this red line which you are seeing, this horizontal line, is your average volume. And as I told you in the last webinar, what we want is when the stock price is going up, it should be above average. When it is falling down, it should be below average. So this kind of an action we want. That here, if you see, the stock is going up on above average. This is just average volume, average volume. However, when it was falling down, the volumes were pretty low compared to the average line. So this is what we desire, what we want from a stock which is there in our watch list. So basically what it means is if a stock is going up on above average volume, that means that there is a lot of institutional buying in that particular stock, because 80% of the buying is done by the institutions. On the other hand, if the stock is falling down on pretty low volume, below average volume, that means volumes are drying up. And what it means ultimately is that it's the retail guys who are moving out of the stock. Some traders are going out of the stock. Weak investors who cannot hold the stock or who don't believe in the long-term story about the stock is moving out of the stock. So once this weak investors, tend to push the stock prices, drag the stock prices further down, there is, where again institutions keep on giving support. They average down at 50 and 200-day moving averages, as a result of which you will see a lot of spikes when the stock just touches 50 DMA. And that's your basic technical rule, that once the stock bounces from a support level, normally technical analyst would buy it until it for a target of its resistance. So if I have to show you the resistance and support thing, in this particular stock, this green line would have been acted as a support and red as a resistance. Though this chart is not that great to show that pattern, however, we'll see it in other charts. So, so the most important part about canceling criteria in technicals is this base patterns, which is something not very prevalent and common. You will get it in get it on normal technical analysis videos or tutorial. This is something proprietary: cup with a handle base pattern, double bottom, flat base, saucer with handle, base on base, ascending base, high tight flag. So these are the bases which any stock would make before moving into a confirmed rally, or anytime when a stock will have a huge price action, before that it will make a make a base pattern. So we will discuss the first three in details, and that is what you will observe in most of the stocks in India. So that's what we'll go to now. So what are bases? Bases are nothing but a time period where the stock is moving in a sideways fashion. So when the stock is moving sideways, it will fall down, it will go up for some time, again it will fall down. In this way, in this manner, it will kind of make a pattern. So a cup with a handle base pattern do look like a cup, and you will see a handle over here. A double bottom will look like a W. If you see here, it will look like a W. A double bottom, one bottom and two bottoms it will make. A flat base will look like, if you take a short time period into consideration, you will see that the stock will kind of make a flat base, and from there it will break out and move into new highs. So bases generally reveal the optimum time to buy a stock in a bull market. Normally, in a bear market, or when the entire market is in, say, uptrend under pressure or in rally attempt, stock would be making bases. And ideally, when the market is in confirmed uptrend, as we discussed in the last webinar, most of the stocks would break out. So, how does the cup with a handle base pattern form? So, this is the entire maths behind it. So normally for a cup with a handle base pattern, a stock should have a prior uptrend of at least 30%. Now say for example, there is a stock which has already rallied 30%. From there, it's this particular point is a point where because 30% is a good amount of profit, and in any market 20 to 25% is the ideal profit booking range. So most of the investors book profit at 20 to 25%. They wait for the stock to again fall down and pull back from 50 or 200 day moving average before they add on to, before they buy it again, or they wait for the breakout. So normally 25 to 30% is the ideal profit booking range. So this particular stock, how to cover the handle based pattern is formed is the stock would have a prior uptrend of 30%. From here, it will fall down to almost 15 to 35%. So that will form the depth of the pattern. Now, this entire operation of this cup with a handle base pattern should have the length should be minimum 7 weeks. So you have roughly 42 trading session is what we want. So this sideways movement should be of 42 days minimum before it is called a base. And once it hits the bottom, if you see here, it will kind of make the right side of a cup. After making the right side of a cup, again there will be some correction over here, and just a mild correction, and then again a rally. So this particular point is your pivot point, buy point, and this is where you are expected to buy the stock. So handle depth is again 10 to 15%. Here the depth is 15 to 35%, and the handle's depth should be 10 to 15%. That's a mild correction, we say. And handle should form in the top half of the base. So what are the requirements? The requirements are that prior uptrend of at least 30% should be there. And this is consistent with other base patterns I will be discussing. A prior uptrend of 30% remains the same. Base occurs over at least 7 weeks. Handle must form in the upper half of the cup. If you see this handle, it is forming in the upper half of the cup. Volume decrease in handle. I'll show you with the help of a chart that when the volume is being formed, when the handle is being formed, volumes will be dried up. And I've explained you the meaning of dried up volume. And after that, volume decrease in handle, identify the buy point. and the breakout will always be when the volume is say 150% of its average volume, or 50% more than its average volume. So let's discuss it with the help of an example. Now this is a chart of KA Industries, chart of August 2016. Again, this was a multi-bagger stock. Uh, it made, if you can see here, it made a cup with a handle base pattern, and this was the ideal buy point. So let's see. I mean, did it meet all the criteria or not? So the stock had a prior uptrend of 30% from here till here. This entire operation happened in 7 weeks, and the handle was actually formed in the upper half of the base. Volume decreased. If you see here, when the handle was being formed, volumes were below average. If you see here, it's lower on the downside. The volumes were below average. Buy point is 5% within the high of the base. This is the high of the base. During this formulation, this was the high of the base, and from here you can buy the stock from this particular point to 5%. So within 5% you need to buy. William O'Neill says that that's the ideal buy point, and how he approaches it, he would buy a stock on breakout. He would allocate 25 to 30% of his capital once the stock breaks out. The rest 50% he would allocate when the stock is say 2.5 to 3% from the pivot point. Uh, that's the immediate resistance point, or you say the basically the buy point of, or the high of the base. That's again your buy point, and the remaining capital he would invest when the stock has reached 5% from the ideal buy point. So that is giving a kind of conviction to him that the stock is good and the breakout is a strong one, because the stock has already surged 5%, sorry, 5%. And that's how he would average up, and that's the reason I told you that average, when you are averaging up, you're buying on to adding on to the stock which is actually going up in say price. So this was a proper cup with a handle base pattern which met all the criterias, and the stock post breakout gave a return of 220% in 65 weeks. So this is what is called the breakout, when the stock is crossing its pivot on above average volume. That is your proper pivot. So if you see here, this is your, this particular, if it's this particular is your buy point, this particular point, and on that particular day the volume was above average, and this was the breakout. We someone who would have added the stock on this breakout would have made 220% in just over 1 year. Another example of Bodal Chemicals. So just roughly, if you can see that there is a cup with a handle base pattern, and again a kind of a rally. That's the reason breakout is very important, because I told you that when the stock is breaking out, it is making new highs, and it's not any XYZ factor which can help a stock in making its all-time highs or breaking its all-time highs. It has to be something very extraordinary. Then only the stock will break out or breaches will cross its all-time highs. So this particular stock made a cup with a handle based pattern. Again, all the criteria. If the criteria will not meet, the system will not show it as a cup with a handle based pattern. Now, fortunately, in Market Smith India app, you don't have to go and see whether do all the calculations whether it was a cup with a handle base pattern or not. In Market Smith India app, if you open any app, you will see the base pattern. This kind of a pattern will show up, and you just have to click on that and just see the pivot price. Pivot price will be mentioned. See the current market price. What you need to say is whether it's a proper breakout or not. If it's crossed the pivot, and the volume should be above average. If the volume is not above average, then it will not be called a breakout. In that case, it's a sign of a weak, some retail guys buying the stock, and the stock is just crossing its all-time highs. So that means that traders have taken the position who will ultimately dump the stock, and it will come down. We want the breakout to happen, that crossing of all-time high to happen on above average volume. So Bodal Chemicals post breakout gave a return of 200% in almost 40 weeks from the buy point. So this was the ideal buy point. This is the curve with a handle base pattern, high of the base. This particular point is your buy breakout point. If you see the volumes again, on that day, volume is above average, and ideal buy point, buy the stock over here within 5% from the pivot. So continuously stock is in uptrend, and you can see that post buy point, again when the stock is moving up, it's moving kind of always the volumes have been at least average or above average. That's a sign of fund buying in. So that's how it is made. And when the stock is making this, when there is a when the cup is being formed, you can see the downtrend. So these all are the signs that all the investors who would have entered the stock earlier are now booking the profits because they're already sitting at 30%. Over here at the bottom out, again, some investors will who find the stock cheap or who would like to buy a stock at a low P, value investors come into the picture. They buy at kind of buy at bottom. Again, they keep on buying. That's the reason stock is going up. Now, again, at this point, some intermediate term investors who cannot hold the stock for a longer period of time or weak investors would again sell the stock having a profit. So that's the reason this depth is just 10 to 15% and not 15 to 35%. On the contrary, here the depth is 15 to 35%. That means most of the investors would sell it. Here only weak investors would sell the stock. Once the weak investors move away, the strong guys again add onto their position, and that actually ultimately makes the stock to break out. So that's the entire idea about base pattern. So again, double bottom base pattern has a similar feature. There should be a prior apparent of 30%. This is the middle peak of the W, and it should be lower than high at the beginning of the base and above the midpoint of the base. So here also the same, the logic is same that once growth stock basically will be hold by. See, one thing I would like to tell you, growth investors tend to hold the stock for its rally. They will dump the stock once the growth is over. So on the other hand, value investors would try to unlock the value, unlock the potential well in advance. They would try to see something in future 5 years down the line. So if they are already holding the stock for last 4 years, 5 years, and ultimately the stock starts shooting up. So the moment it starts shooting up in 1 2 quarters, it gives them like say 400, 300%, 400% return in that over the last say 7 or 8 years. If they're able to pick up that multi-bagger, in that case, at that particular juncture they would sell their stock, and once they would sell their stock, you would see the growth coming in. If the growth is coming, if the earnings and revenue is growing by 20-25%, growth investors would enter the stock. Then there is a talk about the stock on the streets. Every you will see the call by every brokers. All the investment banks would give the call on that particular stock, and that's the reason people will be after that stock. And there is something in the funds and PMS, and again mutual funds, if a stock is rising up they have to buy it, otherwise they'll underperform their peer. So last year, that's also one of the reason why a lot of stocks just rally abnormally, because last year Graphite India, Philips Carbon Black, all those stocks were something everyone wanted to buy because they knew that if they won't buy the stock they would underperform their peer. So mutual funds they have this kind of a fear that they don't want to miss on any opportunity. So fear of missing out is there, and it's a common human biases, and it works in the favor of retail investors. Someone who is very smart. If by now I know I have given you a lot of clues where how to look for fund buyings, how to look for this breakout can help you a lot, because breaking out is something which is extraordinary. You will not see. And also, this breakout will not happen when the market is in correction. In 2017, 2018, that's last year when the market was weak, very few stocks broke out, and 80% of the breakouts failed also. So you need to be very expert in identifying the breakouts. And in the sell rules, I'll be discussing that why you should cut your losses at 8%, and no matter what, no matter how long-term investor you are, and how to re-enter that particular stock. And the only reason is that if you cut your losses short at 8%, in that case, even if the market condition is getting say up degraded from uptrend under pressure to uh, say correction, or from confirmed uptrend to uptrend under pressure, in that case you would have some time to do. I mean, you just cut your losses short, because when the stock falls down, it falls, it might open gap down, but then when it rises up, it's not the same kind of a momentum. So people are more, once they come up to selling, people are more aggressive in selling than buying. So that's the reason we say to cut short the losses at 8%. That's one of our sell rule. We have other sell rules which I'll discuss now. So again, a chart where the stock made a double bottom base pattern. It had a prior 30% uptrend. The entire sideways movement happened for 7 weeks. This particular pattern is a double bottom pattern which resembles as a W. It's kind of a lopsided. The second leg of W must undercut the first leg. That now this is again an important condition. So this is where a lot of people make mistakes, that they think that if it resembles like a W, the system will, even if this if it won't undercut this particular the first leg, the system will show you as double bottom, but it's not the proper base pattern which it would be. And that's the reason this particular, in that case, a lot of breakouts fail. If you pick up, if you don't read the charts properly, if you don't follow the rules, that case the breakouts will tend to fail, and then you will just blame that it did not work out. But ideally, it was the mistake of the people who was reading the chart. They were not just focusing on all the rules which was mentioned. So again, the buy point, now if you see just post breakout, just see how gap up the stock is opening. Now again, gap up opening is a very bullish signal. That means that there is something extraordinary in the stock, or definitely any funds would have bought this stock. Now giving you an example, today Titan opened gap up. Go see the chart. Titan has opened gap up. If you just see one day old news or today's morning news, you would be you will be able to relate why did Titan open gap up. Just see the news and take it as your homework. See the news, see the chart, you will be able to relate what was the reason that Titan opened gap up today. Okay, so again another chart of Ashok Leyland. This particular stock here, see a lot of, so now ideally if you open a weekly chart, it will look like this one. This is a consolidation based pattern, double bottom. If you see here, it's a double bottom. So in daily chart, the picture will be more clear, and before that it's a cup with a handle. This, okay, so all those base patterns would be there. And if you see here, this cup with a handle base pattern, this breakout was the first time you could have bought this stock. If you miss it here, you would have bought it here. You can buy it here. Someone who missed over here could have bought it here. So a lot of entry points would be there. And someone who bought it here, it's an addition point. Average up over here, again average up here, average up here. That's how kind of add on to your position to a multi-bagger stock. So this is the kind of, this particular stock, Ashok Leyland, was multi-bagger in 2016. It gave a return of 62% in 32 weeks. So to have this kind of, so ideally you need to check the earnings also. So what, as per my understanding, possibly these all breakouts would have happened right after the earnings, or all the auto companies and tractor companies would come up with their numbers on a monthly basis. So on every month, if the sales are increasing, definitely the stock will do good. Okay, so again a flat base, it remains the same here. The uptrend at least 20%. It should be 20% rather than 30%. The buy point is peak of the base. It's pretty simple. This is the channel in which the stock will move into. The depth should be less than 15%. It should not be more than that. Ideally, if the depth is more, the uptrend is more, it will be look like more of like a cup pattern, or it will have a tendency of double bottom base pattern. So this is a flat base. The length is of at least 5 weeks, and the peak of the base will usually be, this is the peak of the base. So once it crosses this level, you have your breakout. Again, check the volumes. Breakout. Just crossing the pivot doesn't mean a breakout, for your information. You need to check the volumes. The volume should be above average. So what are the checklists? The prior uptrend of at least 30% is important. Base occurs over at least 5 weeks. In the previous cases, it was 7 weeks. Here it is 5 weeks. And the price range during base is less than 15%. Volume dry up, shake out, identify the buy point. Now, these all things are just that's a minimum requirement before software will tell you whether it's a base pattern or not. Now, if you come across a stock where the uptrend is, if you come across a stock where the uptrend is say 50% and then base occurs over 12 months, say, yeah, 12 months, 1 year. So just don't ignore that, because these are the minimum conditions. It should be, what we mean to say is there should not be a base formation of say 2 weeks and you are just buying the stock. So if a stock is actually breaking out of a long base pattern, say 1 year or something, that's very strong signal. So one stock, Zydus Wellness, last year November, the stock broke out of a very long base pattern. It was kind of moving sideways over the last 1.5 years. So last year it broke out, and while researching, we observed that the company Zydus Wellness basically manufactures that sugar-free. All must be aware of sugar-free and Nutrilite butter. So that particular stock broke out during that time. And what we observed is the company gained the market share in the last quarter. We were pretty much confident that if the company has gained market share, definitely the earnings would come in the upcoming quarter in the balance sheet and financial statements. The same happened, and since then the stock has given almost 50% in the last 1 year. And recently we saw the company acquiring four key brands from it is actually acquired for the Zydus Wellness is acquired four key brands: Horlicks. I'm not sure about the other three. I'm not able to recall now. Just check it. So again, Zydus Wellness is a very good stock because having it's a market leader in four of the brands which they were holding: Nutrilite butter, Nycil. They are also acquiring Nycil. So all of a seven, it will hold seven brands, and in those seven, it will again become a market leader in five brands. So it's a market leader. Check for the base pattern. Once it breaks out, that's again a very good stock. And kind of, I have actually mentioned a very good stock. Any one of the team can use it for their pitch also. So yeah, you can check Zydus Wellness. It looks pretty good on fundamentals. Check the technicals where it stands on the chart. So again, a daily chart of Maruti Suzuki. It's a flat base. Just see the base. This is the breakout point. Again, just before the breakout, once the handle is formed, or when kind of weak investors go out, strong investors, they keep on buying on huge numbers, and that's the reason this kind of a volume is there. And just stock will break out, make a new base, again going up. This stock gave Maruti Suzuki in 2018 gave a return of 24% in 6 weeks. It's a heavily weighted stock in Nifty Composite, and possibly if Maruti is giving you 24% in 6 weeks, that means market is actually in confirmed uptrend. Another chart of Blue Star, where this stock gave 70% in 52 weeks from buy point. Just see the volumes. So all the investors who made money over here, they are kind of moving out. See sell off on above average volume. When the stock is falling down, again they are buying, and ultimately the stock broke out. After the breakout, it gave 70% in 52 weeks. Okay, so got a question that Maruti looks more like a cup with a handle based pattern. So see, the depth is not there. That's the reason it's not cup. If you're considering this, the depth is not 35%. That's the reason it's not cup with a handle based pattern. It's more like a consolidation. It was trading in this channel. If you see this point, it was trading in this channel, and post that it broke out. That's the reason it's flat base. But that was a very good observation. Yeah, that was a very good observation, by the way. It's a daily chart of Blue Star, which is pretty much more clear. So again, here, if you just take this particular point of a chart, it might make a cup here. See, the depth is very good. We need to see whether it's 15 to 35. From here, if you see, if the cup is starting from here, it might make a cup with a handle base pattern. We don't know. We need to go back and see. However, if we take this particular time period into consideration, it made a cup. Flat base pattern. So what are the checklist of buying a stocks? So first thing which you should see is the market in a confirmed uptrend or not? Okay, I just received a question. The peak is not at the left though. See, if you consider, if in particular, if this is the time frame for the cup with the handle base pattern, your this particular, so if you just consider this point, This is your highest point. After that, this became your highest point. This became the, intraday, on an intraday basis, stock crossed this, it became the highest point. The moment it will cross this is your what is your breakout. So here, if the stock would have ended in blue, however, if you see here the I mean, in that case, if the volumes would have been above average, possibly this would have been your breakout. But then this was not the breakout, and perhaps you see the small downtrend over here. So ideally, your pick should be your pivot, and before that, what is the highest point? So it might happen here, or it might happen here, or maybe here. You never know. And also, it might sometimes happen that stock is kind of crossing, trying to cross its all-time highs. It just stays over there. 2-3 trading session, again it just touches that point and coming down. And on a fifth trading session, you see stock crossing that, and the volumes are above average. So those points become your pick. So so buying checklist is, first of all, the market should be in a confirmed uptrend. That is, market should be in rally, because 75% of the stocks would follow the market direction. So only buy the stock when the market is in rally, because if you try to buy a stock when the market is in correction, try to do bottom fishing, in that case odds are not in your favor. Second thing, what you should see is, does the stock you're watching come from an industry group that is showing strength? Now, industry group strength can be seen from our MarketSmith India app. We are not asking you to go and have a look at the Bloomberg terminal or something like that. You can just go into the MarketSmith India app, and I think here we will provide you the support. We will give you the top performing industry. So we will tell you which are the industry top performing, which are the growth industry. From there, possibly we will give you the list of the stocks also. You need to prepare a pitch on the 4 stocks. I think you will get your first task by today, or maybe tomorrow morning at earliest. And we will give you the list. And if you tend to go out of that list, do inform us before. We would just check whether it's a prospective canceling stock or not, whether you will be able to prepare a good pitch on that or not. So industry group rank, but for your someone who wants to know, this is your industry group rank is lower the better. So first industry group rank is the best. So that industry in particular is performing best right now, and it changes every day. On a daily basis, industry group rank can change. So if you see in any software, the sector rotation chart, the chart changes every day. So today, if FMCG is outperforming, tomorrow you might see that again IT might be kind of moving into the outperforming zone. So sector rotation chart and industry group rank is very important. You always concentrate on top performing stocks, but then diversify your portfolio. Be invested into different group, different industry, but always be heavily weighted on industries which are expected to perform well. So in 2019, we are expecting consumer, uh, non-durables, FMCG, retail, insurance sectors to perform. Even pharma, we are expecting these all sectors to perform well. So kind of when we build our portfolio, we will be concentrating on among these sectors. However, we will also have stocks from financials, bankings, and private and PSU banks. Now PSU banks is again one of the sector which is looking good, but then you might not find a lot of canceling stocks in PSU banks. So a fundamental analysis, what all things you need to see: earnings growth of 25% or more in the past 2 quarters, earnings growth of 25% or more in each of the past 3 to 5 years. I told you guys last, it's not mentioned here, that the earnings should be accelerating. It should be, if it's 20% in year 1, it should be 22 in year 2, after that 25, 27, something like this. If you're able to see, definitely that's a sign of a multi-bagger stock, because with earnings your stock price will increase. After that, does the firm's profit margin compare favorably with other firms in the industry? You need to check that why that particular stock is a market leader. Definitely, if the profit margin is a very important thing, because that tells you a lot of a story. Just looking at the profit margin, of the company's generating profit margin, which is kind of say outperforming the industry by 10 to 12%, that's pretty good. Because even if you are getting a company which is having 50% more margins than than industry average, that is questionable, because you need to see what's the reason that they're able to generate so much of margin, and whether it is sustainable. So ideally, you will see 90% of the time it's kind of for a one-off item which is not sustainable. But then if it's just 10 to 12% higher, it's a very important point, because 10 to 12 in when we talk about profit margins, we talk about basis points. And even in the if it's just 100, 200 basis points higher, it's a very big thing. So do check the profit margins and compare it with the other firms in the industry. After that, check the return on equity. It should be 17%. In Indian market, you can go back till 13%. However, see that that return on equity should not have been decreased. 17%, if you are able to get 17%, 18%, it's exceptionally well. However, if you are taking 13%, see that it's from 9 it has become 13, and not from 18 it has become 13. In technical analysis, check that you're watching the stocks which are showing strong technicals. That means simple, you need to see the breakout. So what all these 4 points are saying is that you need to check the breakout. So now we will talk about how to use the charts to time your selling. And before I advance into this, if you have any question, kindly post it in the chat box. Okay, I don't see any question. So before you are buying any stock, always write it down when you are planning to sell it, because that's very important. Buying is something which it's a very easy decision to buy a stock. You can see getting buy advices is very common. You can just get the advice from any common news channel, in any company's website. You go and see, you will see a lot of buying advice. But then selling is something which is very difficult. I'll tell you, 10 stocks when to buy that. You can go ahead and buy those stocks, but then selling a stock is very difficult because, okay, so ATR and Bollinger Bands, we are not going into the details because it's not required in CAN strategy. But then if you tend to, use it, it's okay. But then I don't think you will be given any points in showing all those things in technical analysis. In technicals, you just need to see the chart patterns. In fundamentals, the more you are showing, definitely the more points you are earning. However, it should be, relevant. Say for example, if you have picked up financials and you are showing us the models, which in the banking sector you're showing us price to earning ratio, so that is not relevant. There we would like to see price to book value ratio. So whatever financials you are calculating, all those things, kindly check it. So see, ATR, Bollinger Bands, Elliott Waves, all these things is not covered in this webinar. However, if you are doing it, if you are interested in knowing this, so for swing traders subscribers, we do cover these topics. Just kind of register in swing trading app. When these topics come up on every alternative Thursday, we try to do swing trading webinar on technical analysis topics. If you are interested over there, so register that. There we cover that. However, for the competition, it's not needed. Only this I'll in sell tools, I will talk about 50-day moving average in 200. That's a basic technicals and the chart pattern. So this is the technical part of the canceling. So what are the reasons to sell? First of all, first is protect your capital. That's the 8% sell rule, that no matter what, if your stock is falling down, cut your losses short at 8%. So here is what people panic. They don't sell the stock. The moment you see any weakness in the stock, something, or gradually stock is falling down to 8%, for a time being sell. After that, you have some time, see what was the reason for the sell. If the stock is again coming into the pivot, buy it again. The second reason to sell is locking in profit. Here you are selling due to weakness or you are selling into strength. So we will go into the details. What does it mean? And the third is the distribution in the general market. Here, what we mean is, if the market has been degraded from confirmed uptrend to uptrend under pressure, or from uptrend under pressure to correction, in that case, there is a distribution in the general market. The distribution day count, which I spoke about in the last webinar, if that is increasing from 1 to 2, 2 to 4, again, that means the distribution in the general market. That again calls for cutting your losses short or booking profits if you have made any. So the 8% sell rule, always cut your losses at 8% from your purchase price. So the question is, what if the stock suddenly falls more than 8% before I notice the drop? So in this case, should I wait until it rebounds to the point where it's only 8%? So ideally, whenever you buy a stock on a daily basis, you have a option to put your stop loss. From your purchase price, put a stop loss. Now here, just don't get, say for example, you bought a stock, you are already sitting at a profit of 25%. Here what should you do? So definitely if the stock is falling down, don't wait for 8% stop loss, because in that case it will be it would be foolery on your part to just give away all the gains. If you're seeing the stock, you made 25%, you see that the stock is falling down from 25, it came up to 20, 19, just sell it for the time being. However, it is for someone who bought a stock and it's a case of a failed breakout, or after advancing 3-4%, the stock is falling down. In that case, wait till 8%, because most of the good quality canceling stocks bounces from there. So another question is, should I use a stop loss to protect myself against the 8% drop below my purchase price? Definitely use the stop loss feature in any in any terminal. You will have a stop loss on a daily basis. You should calculate your stop loss and just put it, because if the stock falls down, it will automatically get sold. This is a chart of Tata Motors. Now again, this stock made a cup with a handle waist pattern, and this was a case of a failed breakout. So see, if you are not cutting your losses short, the stock moved into a downtrend. You would have The stock fell to 500. This was the selling point. If you are following 8%, you would have sold the stock over here. And just see, from 544, the stock came till 297. So we actually saved a lot of money. And in the meanwhile, it's important to accept your mistake. If you have picked up a stock, where the breakout failed, it's important to just cut it short at 8%. Because I'll tell you how William O'Neill personally used to invest. He used to buy the stock at breakout. If it used to soar high, he would have hold it. Otherwise, he would just cut his losses short at 7 to 8%. Sometimes he would not even, in a market when the market is very down, he would just wait for 2-3%. If it's 2-3% down, he will not wait for the stop for the stop loss. So ultimately, in this case, the stock fell below its 50-day and 200-day moving averages. Now, this is a death cross also happening, where the 200-day, 50-day moving average is, okay. So normally a death cross is a point where your 50-day moving average comes below 200-day moving average. So in this particular case, I think the color has been changed. This green line is your 50-day, and this is a 200-day moving average. So 50-day moving average, see, this is a death cross, and normally death cross is a, as the name suggests in a technical analysis, it's a clear-cut sell sign. So in a death at death cross, people would have sold. So just see the downside. So if you're seeing any death cross, uh, actually, if you just check the charts of September 2018, you would see a lot of death cross over there, because that particular month market was in correction. Again, a case of a failed breakout. Just see, the stock is selling off on above average volumes. Lot of above average volume selling happenings, then above average volume buying. So from here the stock fell. Institutional selling is a sign of weakness. When you see that, say for example, you are sitting at a 25% profit, and from there you see that there are a lot of down days, and all the down days you are seeing that the stock is falling on above average volume. No matter it's falling 0.5% or 0.4%, if it's falling like this on above average volume, it's a sign that institutions are selling it. Just move it, because immediately you will see stock will fall down 5-7% on above average volume. So these all things happens in the market, unfortunately, and cannot do much about it. But then what you can do is just follow the rules. Now following the rules is somehow, it helps you in eliminating a lot of biases. But the point is, even after rules, people have a lot of biases. They are not willing to sell. A lot of people are loss averse. So they don't want to see that notional. Even 8% loss is too much for them, but they're not understanding that 8% can become 20%, and very soon can erode their total capital. Okay, so another sign is gap down. So this point is that your gap down, stock open gap down. This is again as gap up is a bullish signal, gap down is your bearish signal. So if a stock falls down, it opens gap down, sell the stock, because from there it's very difficult to come up to the higher level. That means the institution has clearly moved out of a stock. Second reason to sell is lock in profits. Now, in this case, it's assumed that you're already sitting at a profit. So take most profits when a stock has risen 20 to 25% from its buy point, that's its pivot point. Post breakout, it has increased 20 to 25%. Buy it. However, there is an exception to this rule. And the exception is when a stock rallies 20% or more in the first 3 weeks post breakout. In that case, hold the stock for at least 8 weeks, because normally multi-bagger stock have this kind of a tendency, and these stocks tend to become multi-baggers. So you bought a stock at breakout, within 3 weeks it gave you 20 to 25%. In that case, hold the stock for another 5 weeks. So in total, hold it for 8 weeks, because we have observed that in 8 weeks, these stocks tend to give 70-80% and become a multi-bagger stock, because after that it might have some profit booking, but then again it will get a good support over there. So in 2017 we had a lot of stocks which became power to pivot, and so here is an example of power to pivot stock. So HEG, the stock is up 20% or more during the first week. It just gave 20%. After that, ideally, as per the power to pivot rule, you are expected to hold it for 8 weeks. This particular stock gave 800% return in just 36 weeks. So that's a classic example of power to pivot and your multi-bagger stock. If you go and see the chart of say KA Industries, Titan, Minda Industries, all these stocks were multi-bagger and they have this kind of feature. So now how to check it in the chart? So you will see it in the form of a flag. Okay, I'll just show you. I'll just show you in the app how you can see this feature. Okay, I'll show it to you later. Let's just complete this. After that, the third reason to sell is the general market distribution. Here, you need to see the distribution day. We explained the distribution day count in the last webinar. The general market direction is down. The current position is in market cycle. So all these three things we need to see. If you see any weakness in these three, kindly sell the stock. Now sell rules review, protect capital 8% sell rule, lock in profits. You have selling due to weakness, selling into strength. Selling into strength is your profit booking. Selling due to weakness is institutional selling, gap down, or say stock is just moving sideways. And then the third one is your distribution in the general market. So what are some of the pitfalls which you need to avoid? Look for institutional quality stocks. So these are some things which you should adopt. Look for liquid stocks. People generally tend to avoid all those things. Third is avoid charts with good technicals but weak fundamentals. This is very important. That if the technically it is breaking out but the fundamentals are poor, just avoid it. Even if that stock give you 100%, but then we are not happy in getting returns from those stocks which are fundamentally weak. Fourth is general market direction. Your market should be in confirmed uptrend. Don't buy a stock when the market is in correction. So some of the risk factors which are involved in the stock market is your business risk, inflation risk, interest rate risk, market event risk. All these four, I'm expecting that you guys know. You would have read it in your CFA or MBA curriculum. It's pretty simple and it's common. So if you have questions on that, you can ask. Uh, Finally, asset allocation and diversification. So here, William O'Neill talks about how many stocks you should hold in your portfolio. So in that case, he says that we all know the concept of diversification. Don't put all your eggs in one basket. Don't invest in one stock or one sector. Put your eggs in few basket that you know well, and limit yourself to invest in 4 or 5 carefully chosen stocks. Now, 4 to 5 is something very subjective. William O'Neill used to say that if ideally in a year only 2 to 3 sectors outperform, in that case, just uh, hold 75% of your portfolio in those particular sectors, rest 25% diversify. So when you diversify your portfolio, you know there are basically systematic and unsystematic risks. Unsystematic risk is a risk which can be diversified by diversification. You invest into different asset classes. On the other hand, diversifiable risks are those risks which systematic risks are those risks which cannot be diversified no matter what you do. So your undiversifiable risks are inflation, which is not in your control. Exchange rates is not in your control. A political stability is not in your control. Being a fund manager, war is something which you cannot control. So these kind of risks cannot be diversified. On the other hand, company specific risk you can diversify. Say for example, you bet on FMCG sector, you like Nestle. So Nestle has a lot of company specific risk, and we all know what happened last week. Again, the case for Maggie. So stock fell heavily after that. Industry specific risk is, again, don't invest into just one industry. Always diversify within industry and within in particular industry, in between different companies. The third is business risk, that the company's business might be closed down, or though we assume a going concern concept. However, there are businesses that a business, say for example, if company has a plant in some places and where there is a flood, in that case again it's a business risk, and that particular plant may be shut down temporarily, and company might lose a lot of sales from there. So these all things are pretty common, and for this it's very important to diversify the portfolio. So that's all we need to, give you a kind of brief on canceling strategy, buy and sell rules. Now, what you are expected to do is we will give you guys the name of the industry. We will, among industries, we will give you the name of the stocks. You need to do a basic macro analysis, see where India stands now, which all sectors are expected to do good. The budget is coming. Do give due importance to politics, because that plays a key role. So, right, just a piece of advice. If you're not sure how the budget is before election, go and check the budget during the election years, mega election years, because ideally, there would be some common traits which you will discover. So just before elections, it's more of a farm-based, agro-based budget which would come. So just see which all sectors are going to get benefited from that. Pick up good quality stocks related to that. Say for example, if you bet on agriculture, you think that the budget will be pro agriculture, pro farmers. In that case, look for companies which is directly, which they are providing support to farmers in the form of agrochemical, or selling tractors to the farmers, or selling the farm produce. So this is how you need to expand your knowledge after macroeconomic analysis from sectors. See which all sectors are expected to go to good. Check the monsoons. The El Nino effect will give you a good example of how the monsoons are expected to be. Again, if the monsoons are expected to be good, in that case it will have a direct impact on FMCG, because their 45% of their revenue comes from rural areas. And when the rural income increases, they don't go and buy a CK jeans. What they do is they start consuming more of Britannia biscuits, more of Kit Kat. So that's kind of luxury for them. So if farm income is increasing, two-wheeler sales, again, if farmers income increases, two-wheelers sales increases, tractor sales increases. Companies which are selling food, seeds, fertilizers, their sales increases. If monsoons are expected to be good, those things increases. On the other hand, if you're thinking that monsoons are will be there, it's a heavy rainfall expected next year. In that case, you need to avoid cement sector, because there will be less construction happening. Reality will be impacted. Projects will not be completed on time. So that means real estate will be impacted. If real estate will be impacted, companies which are financing those real estate, that means housing finance companies, will be impacted. So this is how you need to relate, and you have mentors to explain you that. Kindly ping your mentors, mail it to them, they'll get back to you. And this is how we want, together to build a case, because we are providing internship opportunities to the winning team. So as I have told you earlier, that we want the best to come and work with us, who are like who understands the CanSlim, who can actually relate to different macroeconomic conditions. So we will give you a lot of time. You will have a time to prepare. So, so I think you can expect the task by today evening or maybe tomorrow morning. So we'll just wind up. If you have any queries for me, kindly ask me over the chat over the for about any canceling strategy, about the canceling buy rules or sell rules which we have discussed today, or anything specific. You can ask me now. Specific to the canceling strategy. Okay, fine. So yeah, I'll just open an app for you guys. Are you guys able to see the app? Okay. So this is the app. What we will do is, I think either we will give the premium access to everyone, or maybe we will create a common ID and password which everyone can use for the premium access, because without premium access you will not get all the features. So this is how the app will look like. You have a market outlook here. You have the evaluation tab, the idea list. This is the idea list of what our research team has generated. Now here you will see a lot of in this particular tab you see the current holdings, which all stocks are there in our portfolio currently. So currently Asian Paints, RBL Bank, Astral Polytechnic. So these three stocks are there in our portfolio. So once you click on any stock, say for example Asian Paint, if you click, so here the stock was added on 19th December, and from then it is 0.3% down. If you click on the report, you get the report, the research report which we have provided, the stock pitch. So this particular product is for the retail investors. So this is the key growth drivers and everything which we have mentioned. Here you can see that the stock broke out, and we have annotated that how it broke out. See the volumes; it was a classic breakout, and the key growth drivers, why we like this stock. Go through it, you will get to know how you can prepare that research pitch. After that, say for example now you want to research on Reliance Industries. Just type Reliance Industries over here. So these are four tabs which are very important. In the checklist, if you go, it will tell you the canceling screen is there, how many canceling criteria it is passing. So it is passing 6 out of 9 cancel. So what all things it is not passing, let's see. ROA is greater than 17%. I told you you can go down to 13% over here, so it's okay. Percentage of high is your how much percent the stock is below its all-time highs. So in this case, it should percentage of high greater than equals to minus 15. Should not be more than 15%. So it is currently 17% below its all-time highs. And EPS rating, that's our proprietary rating. We want the earning per share rating to be above 80, it is 66. So these three things are something which kind of you need to look further into. However, if you are very much convinced about the N factor of canceling, or earnings are very good, in that case we can go ahead and pick this. Now, for a matter of fact, I particularly would have picked Reliance Industries, and we would have gone into details, because Geo is a very key mega growth driver for Reliance Industries, and so based on that, it's a profit. Now it is profit making. I would have gone ahead and looked into the company. There are other screens like Warren Buffett screens matching 81% of Buffett's criteria. Peter Lynch is passing 3 out of 8. Benjamin Graham, it's passing 9 out of 13. So you have a lot of other screens. You can create your custom screens over here. So in evaluation tab, if you click here, you would see everything, number of funds, as I told you. So in total, 1.44K funds are holding the stock, and it has increased. It gets updated on a monthly basis. So over the month, 3.24% funds have the holdings have increased, and the shares held by fund is worth 223.78 crores. It has again increased. So you might see funds increasing, but shares held by funds, increasing less. So a lot of funds just trade between themselves in open market. You get the beta here, alpha here, return on equity, cash flow, PE ratio, EPS growth, everything is there, and you get the quarterly earnings. If you just click on show more, you see the quarterly earnings. You can go till 2014, and from there you can see the quarterly earnings. Standalone gives you the standalone figures, consolidated gives you the consolidated figures. Now, before the question comes, always follow consolidated figures if it's available. If consolidated is not available, in that case, you can go to, I mean, standalone data. Now, if you click on related, you will get a relative analysis. So, Petronet LNG is its competitor, Bharat Petroleum, Tidewater. So these are the stocks. So once you click on related, you get top stocks in oil and gas refining sector. In this sector, Reliance is top. So master score is again the score which is based on a lot of canceling parameters, fundamentals. So higher the better. So again, you get to see which stock you need to pick up. If you click on this, if you are researching on this sector, you know that you need to research on first two and need to leave the last two. Stock which is having top relative strength, again Reliance comes first, Yamuna Syndicate. Now, relative strength is more of a technical analysis, but then, however, it says you that how the company is performing in compared to the, other group, other, sorry, the general market. In case of news, you will get the news. However, the news one is something which is not. It's just the news which it's taken from BST filing. So don't rely on news here. Details, if you go in, you get everything here in a big screen. How much is the debt of the company? Go and check all the data, cross check in the company's financials, and yes, chart pattern it will show. If you see here, it's a chart. Reliance chart is there. This is a chart of Reliance. That's the daily chart. Let's see weekly chart. So this is your power to pivot. So stock broke out of cup with a handle based pattern. It gave 20% within 3 weeks. And whenever it will happen, you will see this flag happening. So Reliance Industries recently had a flag, and see it became it was actually a multi-bagger. It made a flag. It gave this 20% within 3 weeks. That was 21%. From then, this particular point, if I take the high was 663. From here, the stock went on to 1330. So that's how the stock almost doubled. And this is the I'll show you some more examples of power to pivot just to increase your conviction level. Say KEI Industries. Let's see KEI Industries. Okay, let's go to monthly chart. It will give you a lot of. Okay, just wait. So again, this is stock. It gave a 31% return in a very short span of time, and then went on to kind of consolidate. It did not fall down much. Let's see VIP industry. You'll see a lot of examples of this kind of part of pivot. Now, in this case, if you see, the stock actually fell down, but then again bounced back. Now, this was the case when this fall was in the month of September, and the market entered into correction. Now, just see, when the market was in correction, a strong stock like VIP, see, it has been a consistently multi-bagger. Of 107 rupees, it went till 5647. From here, even this stock corrected. So that's the reason we say don't invest when the market is in correction, because odds are not in your favor. So from 647, this strong, good quality stock came down till 540. It corrected almost 20%, and then again got some support, and it's trading near its pivot. So it's 5% below pivot. So ideally, how we work is, normally we would have a lot of screens. When it's below 5%, it's a good time for you to, start researching about their stock. So in this particular stock, if you see, number of funds have increased significantly. Shares held by funds have increased. consistently, if you see, earnings growth is strong, but pretty strong. September earnings, if you check 31, 37, 8 to 30, sales is increasing. We check year over year. So all those things, it's a very good stock. So, and see, EPS strength is 93, price strength is 93. It's a very strong stock to go ahead and look for. So in chart here, you need to click. If you click on this, it will tell you which pattern is it. It's cup with a handle pattern. Pivot is 540, and current price is 515, which is 5% below pivot. So once it crosses 540, we would definitely go ahead and buy this stock because we know the story. So we are convinced with the story. We are waiting for the stock to break out. So that's roughly what you are expected to do. You need to see the stocks which are. So say now the question is that you might have a question that which stocks you should pick. The stocks which has already broke or which is trading near pivot. So ideally you are expected to pick up any stock you feel that, say for example, you pick this stock VIP. You can definitely VIP is something which you can, I mean, sorry, when you are picking a VIP, you can pick this stock. In your pitch, you can write everything about the stock fundamentals and technicals. Over there, you should write that you are waiting for the pivot stock to break out. Once it breaks out, you would definitely buy the stock. And the reason, so that's pretty much something which we would consider because we are not expecting that since the time of the competition on 21st, the stock will break out and you took the position there. So once you submit the pitch on 4 reports, the buy point, but then you need to give us the buy point. So the buy point is ideally this 540 is the starting, and from 540 you need to add 5%. That is your buy range. So you need to give us the buy range, that is the range where we would like to buy this stock. So pretty much it's good for you to submit, and we would mark you on that. So I have covered mostly whatever I wanted to. If you have any question, okay, fine. I'll just open Divan Housing for you. Okay, so this is the chart, and I just got an update that every one of you will get a premium access to the product for 1 month. So there will not be one common ID. You guys will have a separate premium account which you can use it. You can use it in your phone and your basically in your laptop. So this is a chart of DHFL. Okay, so if you see DHFL, it was a multi-bagger stock in 2017. A lot of time cup. I think this is a cup-based pattern. It broke out from 153, went till 284. Again, it made a cup with a handle. Though it failed over here, someone should have, who bought the stock over. Actually, it did not break out. If you see, it never break out. It did not break out. It made a cup with a handle, but then it never broke out. From here, it consolidated and fell down. So 140 was the bottom it made. From here, again, it went up, made a cup, again went up. And recently, because of its exposure in ILFS, the news came and stock fell heavily. So whenever these kind of a news are there, just see the kind of selling. This particular day, the stock lost almost 42%, and just see the volumes. This is the average line, and volumes were like 354 millions, almost 8-9 times of its average volume. So this is a clear-cut sign of institution selling. So once institutions have sold, there is no one to give a support, and ultimately the stock is kind of trading at a very low price now. Anything specific you want to know about DHFL? Yeah, I'm asking Sanchit if you want to know anything specific about this stock. So ideally, this stock is now making a base. Let's see. It's difficult for the stock again to come up to 691. So if someone is holding the stock and who did not sell it, say even here, they have to bear the pain of holding this stock. Any more questions if you have? I'm here for like another 4 minutes. If we have question, we'll carry on. Otherwise, we'll just wind up for today. Cool. JK paper. Let's see JK paper. JK paper, I think is getting a good support at 200 DMA if I'm not wrong. Let's see. Yes, so JK paper, though it is falling down, the volumes are not above average. That means institutions are not selling much, and this particular stock is making a consolidation based pattern. The pivot is at 194, which is 23% below. And mostly the stock has got a good support at 200-day moving average. This black line is 200-day moving average. Here, whenever it got support, it got a good. Whenever it tried to breach, it got a good support. Since this point, that is your July 10, 2015, it hasn't breached 200-day moving average. What it means is the stock has a good support at 200-day moving average, and ideally based on history it's a good time to buy the stock, someone who just follow the technicals. But based on canceling, we would like to wait for the stock to cross this 23%. So even this stock made a power to pivot. 28% it gave within 3 weeks, and since then it has increased a lot. So based on support and resistance game, it's a good time to buy because it historically got a good support at 50-day, 200-day moving average. I'm expecting that after Vakrangi, someone will ask me to open PC Jewelers. So Vakrangi was a stock, this is a classic example where we saved our portfolio. This stock was there in our portfolio in 2017, and we removed the stock at a profit of 54% just because we followed strictly stop loss. The moment it reached 50 DMA, it was, I think, we were trading at 64. It came till 57, 58%, and I think there only we removed it. If I'm not wrong, variance of maybe 4 to 5%. So we got 54% in a stock which was bidden heavily in the market. So on February 2nd, 2018, there was a news that uh, they are manipulating their numbers. There is an insider trading happening. A lot of news came for the stock, and suddenly the stock tanked badly. It never came up to that level. Someone who holded the stock thinking that it will come up to that level, it will take a lot of time because most of the big players see these or they all exited. LIC was one of the mega fund which was holding this stock. They have again recently raised the stakes, but I'm not sure of more much. But then the stock doesn't have much, strength now. And based on canceling, it is nowhere near in our watch list because it's very much down from its all-time highs. So breaking the pivot means breaking 515 or maybe recent highs. So Supreme Petrochemicals, it made a lot of power to pivot. If one time, two time, three time, it was kind of a, it was moving good. But recently it has stopped up. It's in a downtrend, consistently getting resistance at its 50-day moving average. This was the death cross where 50-day moving average came below 200 DMA. It was a clear-cut sell sign, and since then the stock is going down. Now it will again, for this stock also, it will take a lot of time to come back to in the to the previous level, previous size. So again, a strict no based on canceling. See, the number of funds have sold the stock, shares held by fund have decreased, earnings are disappointing. So pretty much this particular point was, we need to see why this number came up. Maybe because of some extraordinary items, which is kind of one time. Though I mean, normally it will be removed, but what I mean to say is this might be something which can happen just one time. We need to see about it. I don't know much about this particular stock though. So Yes Bank is again having a problem with the people are not trusting their loan growth book. They're waiting for the new management to come up with a true numbers. They have a new CEO now. They have a new team, and Yes Bank again has the same problem. It is fallen too much. Again, you can see a lot of institutions buying one, two, three, four, five. This entire set was institutions selling off. Just see how badly institutions sold the stock and where it has come now. So it's in stock market. It's all about timing. Where when you are buying the stock, when you are selling a stock. A lot of the mutual funds and PMS, they will have to hold it because of regulations. They cannot just sell it off on one day. Being a retail investor, you have this kind of a liberty. If you follow rules, this if normally 50 DMA, if a stock is breaching 50 DMA, we consider it as a technical weakness. So these all things your mentor will tell you. So 50-day moving average, we would have removed it over here, or maybe we would have waited for 200-day moving average. Still, so here we would have come out invested in some other stock. So we'll end the session now here. I hope it was you guys learned something from this session. We have a recording. We'll send the recording. SRCC guys will send it to you, and you can expect a task by tonight or maybe tomorrow morning. Post that you must have received the email IDs of your mentor. Contact them if you have any doubts. Show your work to them. They'll help you in guiding you forward. So thanks again.